Want to know how you can escape from your daily grind, achieve financial freedom, and live that life of your dreams? Welcome to Charging Forward, hosted by Chris D. Roberts. Listen to entrepreneurs from different industries and niches as they share their current successes and the journeys that brought them to where they are right now. Be inspired, get wise, and grab some vital takeaways from the most amazing business owners of today. Only here on Charging Forward.
Hey everybody, Chris here. Today we're going to talk about the difference between a fund when you're investing in real estate or investing directly into an asset. Now, I also get the question, what are REITs, real estate investment trusts? Those are online. They're kind of similar to stocks, or investing in real estate stocks, totally different. So REITs and stocks are totally different than funds and directly investing in an asset like multifamily. Let's talk about the difference between directly investing in multifamily and investing in a fund that buys multifamily real estate. Let's use the fund example with multiple assets in it. In this example, we have 6 assets that are going to go into that fund, allowing someone to invest in one investment through the fund. So they sign one set of legal documents, a PPM, private placement memorandum, and that investment will be diversified across 6 different apartment complexes. And what's great about that is you spread the risk out. So one way overperforms, one underperforms, you end up with an average. Now, obviously the goal is to outperform every time, but the nice thing about a fund is it's diversification instantly. Whereas if you invest directly in an asset, if something happens to that asset, you're along for the ride on that one asset. And it's like investing in one type of stock versus a mutual fund. A mutual fund allows you to spread your investment over a bunch of companies instead of one. And that's kind of one of the cool advantages about a fund. For this example, let's consider new construction. New construction or build to rent sort of class and A to A plus AA assets. So for example, we're putting in the granite countertops. We're putting in the Zen gardens on the roof, the gyms, the dog washing stations, bike stations to park the bikes, and sometimes restaurants, mixed use, sometimes office and retail at the bottom, and then living up above. We want to create an environment where people don't want to leave because they have everything they need. And so in this fund, you're going to be in a class A asset class, and you're going to be in a market where the average household income is over $100,000 a year. Obviously, those folks want the best of the amenities that are available, and they're also in class A markets like Denver and Phoenix, etc. This podcast is sponsored by Sterling Rhino Capital. Are you sick of the stock market volatility and looking for something more stable and less emotional to invest in? Have you always wanted to be a real estate investor, but don't have the time or desire to be a landlord? Do you want to build a portfolio of commercial real estate assets that grow your net worth and increase your income without having to trade your time for it? Sterling Rhino Capital provides opportunities to everyday hardworking people just like you to invest in private placement commercial real estate assets that make all of this possible. Become a partner and join the Sterling Rhino Capital Investor Club to get access to these exclusive deals. Text the word RHINO, RHINO, to 66866 to find out more. You also get to take advantage of a 3.5 to 4.5 times equity multiple. So like roughly $100,000 in could turn into $350,000 to $400,000 over a 5 to 7 year period. You're going to share in the 8% preferred return for distribution. So in other words, you're going to be paid before any of the general partners are paid. And then obviously share in the average annual return, which is north of 35% based on it being a new construction fund. So you get to share in the cash flow, get to share in the upside, the equity multiple, and you get to share in the depreciation as well when we secure the occupancy letter for the asset, which usually comes around 2 years later. So why would you invest in a fund? Well, you'd invest in a fund for diversification. You'd invest in a fund for the higher than average returns that I just reviewed. You would invest in a fund because you want to sort of mitigate your risk. And you invest directly in a single asset, maybe perhaps because you want to stick to the returns that that asset offers, or maybe that asset perhaps is closer to you. Whereas in like our fund, let's say we might be investing in assets that spread over, say, 2 to 3 different markets. And so some people like to invest right in their backyard. And in this case, you'd be investing in downtown Colorado and downtown Phoenix, Arizona. And this is because of the very aggressive migration of folks and the corporations that are going into those markets. Just massive growth in average household income and massive job growth. So if you're an accredited investor, you can get into this fund for as little as $50,000, and your hold time is going to be somewhere between 5 and 7 years, well diversified across several markets, and there'll be several different assets that are in this fund. But those are some of the reasons somebody might invest in a fund versus maybe investing in a single asset. Mostly all about diversification, higher than average returns, and then just your level of comfort with the investments. So how do you get started if you're interested in getting into the real estate space? Well, basically you go to the website and you click the Get Started or Invest Now buttons. You go through and review all of the documents associated with the deal, watch the webinars, the videos, etc. Reach out if you have any questions. You'll review the legal documents, the PPMs. You'll sign all of those documents electronically. And of course, we encourage you to talk to your CPA if there's any reason to do that, which oftentimes folks want to talk about K-1s and depreciation, etc. So if you want to do that, feel free. And then once you've signed those legal documents, you'll get the wiring instructions and you're invested. You're ready to go. And that's how you get started in real estate investing funds.
Thank you for listening to another inspiring episode of Charging Forward. We hope you enjoyed your time with us. To access today's show notes and other resources, head over to chargingforwardpodcast.com. If you like the show, please head over to iTunes, like, subscribe, and leave a review. Start building a better future for your professional ventures and step into your financial freedom. Join us again next time here on Charging Forward.